We get calls from people who just have no idea what's going on in their retirement plan, and they know they have to do something, they know they need a change, but they don't know what to do or where to go, and that's why they're calling us.
I think the main draw is the concern to run out of money, and I think they're looking for some type of answer. You're not taking double-digit losses, you don't need double-digit gains. Is an extra 5% really worth risking your whole retirement on? When you remove the emotions, it's an objective situation. It's not opinionated. Here's the money that you have. Here's what's at risk. Here's your liabilities. Here's the gap. What do we do?
Hey, everybody. Welcome to the Greenlight Retirement Show. I'm your host, Brian Lindbergh, and I'm joined by our co-host, Tim and Corinne Fitzwilliams. How y'all doing?
Doing great, Brian. Glad to be here again.
Great to hear it. Hey, and we got our other co-host down in supposedly sunny Florida, Ron Wright, our chartered financial analyst. How you doing down there, Ron?
Doing well. It's supposedly sunny, not so much at the moment, but we'll get back there.
All right. Well, we're looking forward to coming to visit you and catching some of that sunshine one of these days soon as well. That said, though, speaking of current events like the weather, Tim, we had some stuff that we really wanted to get cooking on this morning because there's some major market events. Right before that, I just want to let you guys know this is an educational podcast, informational only. These scenarios, thoughts, concepts might sound like you, look like you, feel like you. Maybe they sound good to you, but give us a call at 757-961-0700 so you can meet with one of our advisors and we can talk you all the way through all the cofactors and things to be thinking about. But let's have a little fun and talk about what's going on. What have you been seeing, Tim?
Oh, my goodness. So Ron and I were talking about this as we were preparing for the news to go on and do our thing on the local channel. And it's crazy, the FOMO and the hype. It's amazing how real that can be. And what's sad is it can affect people even though they're not involved. So July, what happened in July? So you have this person who was from OpenAI. He was in his 20s, and he leaves and he creates a hedge fund called Situational Awareness. And following the hype, he's like, hey, guys, let's get in here. And so he raises a bunch of money. We're talking like $10 billion. And then he starts leveraging that dollars. And so he's getting, basically a loan on that money. And so he's leveraging it, and he gets leverage. And I'm sure the investors are cool with a little bit of leverage. That makes sense, right? They're going to be in a high-risk profile, speculative, blah, 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 sure. But then you start seeing 3X, then 4, and then 5X. And so now these investors are freaking out and be like, man, this is too hot. I'm not in this kitchen. I'm getting out. So they start to bail. And when they bail, that lowers the value of the fund. And when the fund's value going down, now you start getting the margin call, which means the people that lend the deal are wanting their money. And so now all the stuff you put up for collateral, all the Fortune 500, good, nice, wholesome stocks that you might come to love and like, right, that you've had, are now going to perhaps lose value. So you can just be going along your life in your target fund of your 401k and see a drop and have nothing to do with this AI situational awareness hedge fund, but actually feel the results. I'm not saying you did or you didn't. I'm saying you could, because that's the process of it. So this thing then crashes from the beginning of July at $45 billion all the way down to $10 billion, where a super smart other hedge fund, Citadel, comes in and buys it out. But I just thought that was crazy to think that the FOMO and the hype could be that impactful that somebody would take and say, you know what, this person's from OpenAI, and just because they're from OpenAI, we're going to go ahead and we're going to let them open a hedge fund in their 20s with no investment experience on that level and leverage it out. That just blows my mind.
Yeah, it's just amazing. The banks were really just literally lining up and throwing money at this thing because all the hype with the AI build out and everything. And so, he just kept getting money thrown at him and kept investing in these startups, right? And that's what caught the market off guard. Was the last month there was a big sell-off in these AI stocks, and there was a lot of concern. People weren't really understanding where it was coming from. And finally, when it all came out, and we found out this is what had happened, that this situational awareness fund had been way overextended, way over-leveraged, and started having to sell off its assets at fire sale prices, just like you said, Tim. And, eventually Ken Griffin with Citadel stepped in, was able to buy the remaining liquid assets at a 10% haircut. So he got a great deal. And it finally brought calm to the markets. And so we saw a very strong rebound off of that, because if there's one thing the market hates, it's uncertainty. And that's what July was. It was very uncertain. Nobody could understand what was causing all of this problem. And so when it all made sense, then people get their feet under them again, and we're back to normal.
I have a question. When you say that Ken stepped in, and to the listeners, because it can be a little complex, right? You got a 10% discount rate. Can you explain really what that meant? Because are you saying that he got it cheaper than what it was started at because they were in such turmoil, they took a loss and gave it to him at a 10% below the start? Like, help us understand a little bit of that logistics, because I think listeners are like, well, what does that mean? He came in at 10%, or why did he come in?
Sure. Okay. A couple of things there. Let me start with, why did he come in? Because, Citadel is one of the largest hedge funds in the world. And Ken Griffin, they have the wherewithal to be able to step in at a moment's notice and buy tens of billions of dollars worth of stocks. So, he's almost at the level of a central bank coming in, and buying these things. This really reminds me, just as an aside, of, we go back way back into the 90s. Long-term capital management was the hedge fund in the world back then. And this same kind of thing happened, but it turned out that to bail them out, central banks had to come in and provide the liquidity to bail them out, because they thought if they didn't, the whole system would fall. And in the wake of that, we had the Russian currency crisis and a lot of difficult times in the marketplace. So that's both how Ken Griffin was able to, because Citadel is such a big fund and had the capacity to, and also why he felt he needed to, because this could have been a systemic event. I mean, we're seeing it impact the market everywhere. All asset prices were being sold indiscriminately because there were margin calls everywhere that were coming in, because we have a very leveraged marketplace. So, yeah, the price. So when we say a 10% haircut, let me back up a little bit. And there's a lot of dynamics in the markets that people don't see that happen behind the scenes. And the market is, in some ways, a good old boys club. It's about who you know. And within the industry, in these hedge funds, these are the guys that talk amongst themselves.
So we're not talking about insider trading, folks. So don't freak out. We're talking about going to get coffee or dinner or lunch like normal people would if you're on Wall Street.
Exactly. And so they start to get the feeling and understanding that, hey, this guy with situational awareness is very overextended and is starting to get some margin calls. Well, these guys are very opportunistic, and they don't really care who they're making money off of. They just want to win. And so it's very likely, there's no proof of this, but it's very likely that several of these other hedge funds started front running this. In other words, they said, well, he's going to have to sell these things. That's going to drive the price down. Let's sell short ahead of that and make money, because we know that he's going to drive the price down.
Without getting into the logistics, so we don't need to get into the legal definition. You guys can Google GPT, whatever you want to do. We're just trying to say they're going to try to make some money as it goes down. They're going to try to make some money as it goes down.
Right. And it was not acting on non-public information. It was just acting on assumptions that they had figured out. So it wasn't illegal, but
it was a high conviction thing, given the setup of everything going on out there. It's just a high conviction
But
trade.
that's what FOMO is. And that's what hype is communication and talking and stuff like that. So it all makes sense.
FOMO was the ride up.
And now it's
the high
yeah.
the high
and the hype was all the
conviction.
way down, right?
And now it's the communication realizing it.
Right. And these are the kinds of transactions that, in general, people don't know about, because this is behind closed doors. It's in dark pools. It's in all these obscured trading markets that you're not able to see very clearly. So that drives the price down on these stocks. Then situational awareness has to sell. That drives the price down even farther. And finally, Ken Griffin steps in and says, okay, it's gone from 100, say, to 60. I'll pay you $54. That's your 10% haircut on the price. So it was 10%. He paid 10% below where it had actually already fallen to.
So it's not 10% of where they started from, folks. It's 10% of where it ended up.
Exactly.
That's the key. He got the wholesale deal.
Yeah, he really did. And Citadel was, wound up making, I believe, 9% in July, where the market was down significantly. Everybody else was down. So he had a built-in gain.
Yeah, that's natural, obviously, because you got a wholesale deal. Well, that's really interesting. And what's interesting for our viewers is that it could, maybe, might have, probably did affect your July. That's just the facts. Now, what did we do in July? I love to hear this because I heard the movement. I don't want to take your thunder, right? We got, what, a minute left? So let's come back and talk about what we did in July, right? I think that's a good idea. Let's get into the details of what did you do, Ron? What did you and your team do? Because you're in the dark. You're not in the dark. I love how you say it. We're driving down the road and there's fog on the road. So what do? I don't know where the edge of the cliff is. And you got to think about it, folks, from a fund manager position. And from our model, from our, we're not a fund, but from our business model that acts like a fund, you got to think, man, we're in a kind of a stormy storm and there's fog and we can't see. And where are the bumpers? Where's the rails? And where's the cliff? And what do you do? Do you just follow along and let it ride out and hope it just comes back up? No, we're more on top of it than that. We're more tactical. We're more active. Ron leads it in a different way. So when we come back, we'll talk more about that.
Yep. And so to tie that in, we will talk a little bit more about your retirement time horizon with that as well, too, because it all matters. The fog will clear on the road eventually. The skies will part. The sun will shine again, undoubtedly, as it always has. But it's what's your time horizon along that into needing some access to funds. Stick with us through the break. This is the Greenlight Retirement Show. We'll be right back. Hey, welcome back, everybody, to the Greenlight Retirement Show. I'm your host, Brian Limberg, and here we are. We're going to pick right up where Tim said, but I caught something a little odd last time. Corinne, you're normally really good at interrupting Tim, but you had something to say that you shared with us in the break that was actually even a little bit better analogy than what Tim was using relative to the fog. So we're going to give you a little space here. Tell us what you're talking about from your Navy days.
To be fair, I really wanted to interrupt you, but our person managing the cameras over there had given us the timeline, and I was like, I can't.
Producer says don't do it.
I can't do it in 15 seconds. You were making the comment about how when you're driving and there's fog and you can't see the road and you got to be cautious. As an air traffic controller, there's specific conditions like that where you have to switch from visual to using your instruments. And for some pilots, it's really hard to just trust the instruments and know that they're right. And that's kind of what Ron does. We got people out there doing the stock market and they're trusting what they can see. But, having experts that know how to use the instruments and use them correctly can ensure that you don't have to worry about the fog on the ground.
That's right.
No, that's an excellent point. That's a very good point.
That's great.
So, Ron, how do you control and what were you looking at? I mean, in the analogy there, you have the visual flight rules of, hey, everything's going fine, the market's going up, but your instruments, the data seems to be telling you something different sometimes. And sometimes the data is telling you one thing, but you're seeing something different. Like, what was that like for you in July? Like, what were some factors that you were considering and looking at?
Yeah, so July was a really wild month for us because, most people, they only see the end of day kind of data, right? So what were the returns at the end of the day? Where was the index? Right. And they didn't see all of the intraday stuff, the stuff that happens during the day. And the volatility that we were experiencing during the day was becoming really extreme. And when you've been in this business long enough, you start to get that feel of, hey, it looks like a duck, it walks like a duck, it quacks like a duck. Maybe this is a duck. And this was very reminiscent of the kind of things we see when there's a buildup of risk in the market and there's something coming. Don't know what it is precisely, but something is on the way. And so as we walked through July, there was a lot of this building up. And so our approach, as always, is to reduce risk, to manage risk, and trying to get the best returns for each increment of risk that we're taking. And so as the risk is increasing, that means we have to be very aware that maybe we're holding too much. And so incrementally, we begin to de-risk the portfolio. And so that's what we started doing. And we do this, we look at all kinds of, at the portfolios in all kinds of different ways. But one of the biggest ones that we use to manage risk is diversification, right? We want to make sure we're not holding too much of any one thing. And then we want to be optimally diversified. In other words, if we're going to put money somewhere, it needs to be in the right place, not just everywhere. The best possible asset class or sector. So we took a look at where we were, and we found that as things have been really progressing and these AI companies have been growing and growing and growing, that really pushed our allocations out of line. And we were almost at 4% allocation in just one company, NVIDIA. And that terrifies me within the portfolio. I never want to hold that much of any one single company. So, one of our first steps was, okay, we got to step back from this. We have to take a look at what we're holding and see how we can reduce our exposure to this sector, and in particular, those specific companies. And so we rolled that back, but we also wanted to be fully invested because we didn't want to miss out on what might be out there. Just because we're driving in the fog doesn't mean we're running off the road, just means we want to be more careful. So we did a little reallocation towards value stocks, to healthcare stocks, because we wanted to take advantage of those sectors and take advantage of the relative performance with those, and at the same time reduce the risk profile in the portfolio.
And Ron, I just want to say something real quick, because that's so important. Folks, you're listening, right? Is your advisor that you've been working with for 30 years, are they doing stuff on a monthly basis? I don't know that answer. Only you do. Only they do. But all I can tell you is that when you're that active, it feels great to know that somebody has their hand on the wheel on, as he said, an intraday aspect of seeing things day to day and making adjustments. I mean, I just think that's phenomenal, risk preservation. I mean, I think it's amazing to do that. And I think everyone should have that in their planning. But unfortunately, that's not how a lot of advisors do things. A lot of people are set it, forget it, don't worry about it, no big deal, blah, blah, blah. And it's not tactical, and it's definitely not active.
I was really, I really loved hearing you talk about how diversified you are when you're looking at where to invest and planning and not putting it all in one basket, so to speak, because in the entire concept of retirement planning, that's what we've always
balanced
stressed,
approach
is making sure that you diversify
100%,
everything.
The balanced approach.
Well,
that's the name of the show. Green light retirement, right? Do you have the green light?
We look even across, not just because we manage different types of assets, right? So we have a bond strategy where it's just bonds. We have current income, we have stocks, and we look across the whole group to see, okay, how exposed are we to technology, maybe? Because there's a lot of these technology companies today are issuing bonds, right? They're selling bonds for the first time in history. Google, Microsoft, these companies are actually selling debt, and that gets picked up by some of the funds that we use. So we have to look across all of our holdings to make sure that we're diversified in terms of the sectors, that we're not holding too much technology because we've got a lot of bonds issued by technology companies.
And is this that whole thing like we talked about with NVIDIA, where they're issuing bond-like instruments so that they can give it to people that don't have the money that would be great clients?
That's a research project that Ron and I are kind of working on. Maybe not fully ready to chat about it.
But that's something that's out there, right? That you could issue a bond, or you can issue debt to what could possibly be a client, so that they can buy more from you.
there's an interesting level of vendor financing going on out there. And it's vendor financing is not quite the vendor financing of old. And if you stay tuned to the Greenlight Retirement Show, Ron and I are going to get to the bottom of that one eventually for you guys. And we'll bring that to you in a future episode. It's super interesting to me. I'm super curious in it, maybe even more so than Ron. But nonetheless, it's something that's out there. I think what we're getting at and driving at, though, is like when we're talking about diversification, if you're listening to this show, chances are you're probably nearing or in retirement, right? You're pre-retiree or you're a retiree. That's our target client. That's who we serve. Not that we can't serve other people, but everybody in Wall Street, if you will, anybody in the financial world, there's a saying that says you speak your book or who your client base is because you know them very well. We know, and I don't mean this to sound arrogant, forgive me if it does, but we know the retirement age client fairly well. Mm-hmm. In the markets that we're in, we're blessed to have hundreds and hundreds of clients. Like we tend to know the retiree pretty well. And so these strategies that we're sharing with you guys and talking to you guys about is just simply these are strategies that apply incredibly well to the retiree because, time horizon, which is kind of our next segment we're going to kind of bridge into here in a little bit. But time horizon's everything. Like everybody knows that AI is probably going to succeed. I think, Tim, you said it earlier, like AI is going to outlive all of us, right?
Yeah. Can I tell you something?
Yeah.
Our neighbor was having trees cut down yesterday, and I stopped the guy with like the bobcat thing to ask him a question about one of our trees. And he's walking up to me and he's got this tablet in his hands and he's like, just give me 1 second. And he's like pushing buttons and then he looks and he goes, okay, we're good. And the bobcat starts walking towards the tree on its own. And this is like one of those big stump grinder trees. Yeah. I'm like, that's AI. It could kill a person right now. But it knows the difference between people and trees. Yeah. And I'm like, this is insane. You're controlling it from like a tablet.
Or does it know the difference? Dun, dun, dun.
Yeah. And it's like technology, AI, it's taking over.
The technology is going to be here. The technology will survive. But if we remember our stock market history, most of us listening to this show were alive in 1999 and know about the dot-com bubble. Not every website made it. And in fact, one that I love to talk about, and I don't mean to pick on this company, I'm actually a customer of this company now, but Chewy.com, not a recommendation. You guys might not know this, but if you do a little bit of research, Pets.com existed back in the dot-com bubble, and it did very well, but it famously crashed because the technology was ahead of where the market was. We weren't ready for mail order dog food back in 1996, 7, and 8, right?
We weren't exposed to it.
We weren't exposed to it. We weren't there. But look at what's one of the, it's an S&P 500 company now. It's a massive multinational, multi-billion-dollar organization. But the technology is 25 years older than the actual revenue is today. So we have to get into, folks, if you need money from your retirement investments, like you have to consider the investment time horizon of the companies that you're investing into. And that's critical if you're already in retirement ages. I'm running out of time. I'm excited to get into the next segment with you guys talking about time horizon. Let us pay a couple of bills in this commercial break. Stick with us in the Greenlight Retirement Show. We'll be right back. Hey, everybody. Welcome back to the Greenlight Retirement Show. I'm your host, Brian Lindbergh, and we're going to get ready to go into this segment. We're going to talk a little bit about time horizon, but I wanted to set the stage with two things. We're going to get into a little bit of a story here. So, again, want to remind you that if you align with the story at some level, it is just a story for today. Give us a call at 757-961-0700 if you'd like some real financial advice. But for today, it's just an educational format and some hypothetical client-style situations. But I want to set the stage for everybody. Imagine that you are living in a small town and 5 large companies just announced that they're going to move to your small town, and they're expected to employ thousands of people for decades and decades to come. So what does your town do? The developers, they borrow money, they build houses. Restaurants expand, new ones open. The electric company constructs another power plant. The bank finances new trucks and equipment for other small business locally. Land prices soar. Real estate values appreciate. Investors buy everything they can because your town's future is seems certain and obvious.
And let me take a little more granular. Everything you said, 100% right. A little more granular. Maybe your Uncle Johnny is calling you up and saying, hey, can I get $200,000 because I'm partnered into a limited partnership on this new neighborhood, right? So it comes down to your wallet. It's not just the word investor as in, oh, this is some pie in the sky. It gets down to your wallet.
Absolutely. And so this town is being built on the population everybody expects to arrive, not the population that's currently living there. Buried underneath the prosperity is one enormous question. What happens if those companies need half as many workers as promised, renegotiate their commitments, or leave before these mortgage payments are fully paid? This is the analogy of the hyperscalers today. This is what we wanted to talk to you guys about today, of where we are at with this economic cycle, because what really matters here is where you fall on this time horizon. Right now, we're putting seeds in the ground. If you're already in retirement, if you're already taking money out of your investment accounts, it's very difficult to get a harvest from something you put in the dirt a week ago. That thing's going to take time to mature into a plant that's going to produce real fruit. If you have some time to go, maybe you can wait for the fruit to be there. If you're waiting for the farm to actually become profitable, that's going to be a few more years down the line. So as we're making these investments, as your portfolios are going up and you don't really care why, we really have to unpack these risks and understand when you're going to need access to this money, because your time horizon is not their time horizon.
That's a good point, because going back to taking what you just said and using my example of uncle or cousin, and they borrowed your money, the terms might be 10-year terms, 5-year terms, 3-year terms. You need to be comfortable in understanding the time horizon that you can deal with that level of risk. And sometimes, just like we saw with the first story with the hype and the situational awareness hedge fund debacle in last month, right, in July, you can get hyped up. It's exciting to be part of a private placement or something special, right? But it might take time. And so you have to always look at your time horizon. We have plenty of clients that are in private placements that's done some funding to their cousins, uncles. Maybe somebody's opened up a dentistry and they need a little help. These deals exist, but understand the time horizon and get advice on the time horizon. Don't take the advice of the person asking for the money.
Yeah.
Go get other advice, other maybe fiduciary advice that's going to do the research to analyze what the true time horizon is.
You know, I want to point out two things. Stepping on Tim's toes a little bit, it's not always about some relative asking to borrow money. You know, you might have just recently seen this boom in your area and thought, I'm going to go ahead and get that HELOC and do all this changes to the house. My equity just went up. I can afford this.
Oh, that's a good point. Yeah.
And then you're paying on this house that you estimate to be $350, and then the next year city tax papers come back and it says it's $250. Well, you don't get a do-over with the money. You're still sitting where you were. And then stepping into what Brian was saying with this story, you made it sound like this is, you know, a made up story, but this has happened multiple times all over United States. My sister lives in Wisconsin, so the one that I was talking to Tim about happened out there, and there was a company that was promising to come out and had, I think, like 130,000 jobs. They were estimating it was going to bring in like 16 billion, 10 billion in factory work, 13,000 jobs. The city itself started spending billions to make changes and to add streets and property and all this. And then by the end of 2017, there was only 14,000 jobs. And that was it.
Because it can come short. Sometimes it doesn't always work out. And that's the issue. If you don't understand the time horizon and it comes up short, what does that mean for you? Hopefully you can stand tall and say, well, it was only a portion of my portfolio, so it wasn't a big deal. I'm okay. But that's why you got to look at this stuff as speculative.
Well, I just like to point out, right, because as we talked about several times today, we talked about diversification, not all eggs in one basket. We've talked about time horizon. Ron, as you think about this thing from the portfolio level, as you think about this thing from the market history, as we've seen technological, booms and busts and things like that before, when you hear us talking about it from this perspective, what are some of the portfolio construction things that come to your mind?
Yeah, so let me kind of frame it too. That this is everybody is comparing this to the dot-com era. This build out as compared to the dot-com era where we had these companies that were building out the infrastructure, exactly what you're talking about, in anticipation of somebody using that infrastructure. We're using fiber optic cable today that was put in place in 2000 and before because of that dot-com boom that we experienced. But we're using the cable that was put in place by some companies that don't even exist anymore because the revenue streams didn't come on in time to save them. So that's the concern that people are talking about now. One of the things we look at for the companies that are out there right now is the backlog of orders. Now, the backlog of orders for some companies back in those days, JDS Uniphase is a famous example. They had a lot of interest, but they didn't have actually orders on the books. They just knew that they were developing this technology. The telecoms knew that they just knew that it was going to come along. They didn't have actual orders, paid orders on the books. The data centers that we have now, they actually have paid orders on the books, and they have demand that is really not pounding on their door. So it's a bit of a different thing, but that doesn't mean that demand can't evaporate, and we've seen that happen before as well. So all of these perspectives, we look at when we're building out the portfolios and allocating resources, and what we do is we assign risk to all of those things. What's the probability of this happening? What's the probability of the good scenario versus the bad scenario? We pull all those together, and that's how we're allocating our resources.
Let me ask you, private placements, syndication, limited partnerships, things of that nature, why is it as a firm we don't get involved in that even though the returns are really high? Is it because of the time horizon? What's in your mind of why you feel that those things are off limits from a firm level?
Sure. So you have to understand that there's different types of risk, right? And so it's not just prices going up and down. There's what we call liquidity risk, and there's timeline risk. That the funds won't be there when you need them. That's your time horizon risk.
That's that you can't get access to the money like we were talking about. You might be locked up for some time.
That private credit story from the first half of this year.
Mm-hmm.
Yeah, exactly. And there's been continued withdrawals out of those private credit funds because people are still wanting to get their money back out because they didn't understand that they were locking up those funds for 5 or 10 years. They felt like they could use that, and unfortunately, they're not able to. So they had to rely on funds from elsewhere. But that's why we don't really delve into those. Now, if we had individual situations, a client that really was qualified and could do something like that, I'm sure we would advise them on that. But for our clients who we're talking about, Brian was referring to earlier, retirees and folks who need access to that money, probably within a year, then that's just not an effective investment for them. And so we avoid that for the purpose of providing that liquidity.
And something regulatory to look at too. Correct me if I'm wrong. I'm kind of guessing here, but it kind of paints the picture, right? I would argue that the SEC would be very stringent on the audit questions and follow-up and documentation process if people did get into those types of investment models through a fiduciary because of how risky they are.
So there's been a real push in the industry to try and create a fund that invests in those things that the everyday investor can get into. And so there's been attempts to do that, and they've not been particularly successful. In the end, what happens is if you create a fund that gives the liquidity to buy in and out of those investments, guess what you've got? You've got the same as everything else. It just becomes the same as the market, right? So there's no benefit. There's no what we call alpha, right? Excess return from those investments. And so they just don't make sense for most people.
And you probably have to have a leverage too, because You got to be in at the buy rate, and then you still got to be able to provide the liquidity if someone comes knocking.
Mm-hmm.
Yeah, most people don't understand. It's not like you just put $100,000 in. You put $100,000 in and promise that every time they come knocking at your door, you're going to add another 50,000.
Right. So you got to have that money, which means you probably got to have leverage to be able to have the liquidity to give to people.
Well, and on the flip side, most of the time you're buying real assets, and real assets don't exactly have a PIN code you can pop in and get cash out. And so that's where the leverage comes in. So you have this asset, you bought a shopping mall worth $50 million. You have some redemptions. And so you take out a loan against the asset value, the equity that you have, to provide some liquidity for some of the redemptions. And now all of a sudden you've got leverage, you fulfilled the liquidity, and you just hope people don't call for more money. Oh, and people called for more money. You take out another loan, and eventually you hit a cash strapped point like we did in the private credit market.
Well, I think you sum this up when people are looking at these deals. Should I take that HELOC, Corinne? Should I do private placement with my cousin, right? Should I get involved in this model that I'm going to have illiquid models? You're hearing effectively experts tell you that it would be very difficult for us to do that and do it as a fiduciary, which means it's a high risk, difficult thing to execute. So don't take it lightly. Don't take it as, oh, I'm just going to get involved and I'm just going to throw a couple $100,000 here. Everything's going to be okay. You really need to know the person. You really need to know the strategy. You really need to understand how it's developed. There's a lot of things that people do in these models where they'll be like, hey, I know I owe you a year of interest. I'll tell you what, I'll let you get in on the next deal for X amount of extra if you cut me a deal on the front part of the interest that I owe you, right? There's so much. It's the Wild West, folks. And that's why fiduciaries can't get involved so easily, because it's the Wild West and we can't put our clients' interest at the forefront when we can't control the environment that's around them as well as we can with traditional modeling.
Right. That's exactly right. That's a great point, Tim. That, we have to be able to evaluate how are these investments going to be handled by the managers of those investments. Can we trust them to do what they're saying, or are they very opaque in their business practices, and so we just can't tell? So that makes those very difficult. And this is why the SEC has the requirements of a qualified individual. And there's a reason for that. It's because, you have to be able to accept losses on a large level or accept the fact that you're not going to be able to touch this money for a long time in order to do that.
That's a very good point.
Well, we're going to continue the conversation right after we get back from a little bit of a break here. This has been the Greenlight Retirement Show, and we'll see you one more time. Hey, everybody. Welcome back to the Greenlight Retirement Show. I'm your host, Brian Lindbergh, and we got one more segment for you here today. We want to tie it all together. We've talked about a lot of different things today, from the AI infrastructure build out to some of the craziness and volatility that's been happening, and a big conversation on time horizon and why it's so important. But we haven't quite gotten out of this AI infrastructure build out, and we're going to tie it into financial planning for you here real quick, is what is the time horizon for this AI infrastructure build out that everybody's talking about? Because at some levels, it feels like the market is pricing it that they're going to bring in revenue tomorrow. At other levels, practically, we know that they have barely dug foundations for these data centers and signed deals with cities to even bring data centers to these cities. So as we're thinking about the types of people who should be investing into these things, if it's the 25-year-old or the 45-year-old that has 20 to 40 years, or how do we approach it differently if we're 75? Ron, could you give us a little bit of insights on what people are talking about this from a time horizon perspective, how long it might take to build these data centers, how long it might take for some of these companies to recognize real revenue from this build out?
Right. Yeah. So I'd like to be able to tell you that these things are going to be ready and profitable in 3 years, 5 months, maybe 7 more days past that.
I'm going to hold you to it.
Put it on the books.
It's on the air now. But the reality is that there are so many more unknowns than knowns in this. We know that they're building out the infrastructure, but we don't know how long it's going to be. We also don't know how many advances are going to take place while they're building this out, and they'll have to keep on making changes down the road. So one of the things that probably is a good guide for this to help us think about how long this whole process is to look at one of Tim's favorite metrics, the price earnings ratio, which is a reflection of how many years of earnings are built into the price. And when you get these companies with the PE ratios of 40, 50, 60, you're talking 60 years worth of earnings to be built into the current price. That is just astonishing. And that gives an indication of the magnitude of how long this process is going to be. So, is that how you want to match up your time horizon? Do you want to be, an investor with a 10-year time horizon investing in an instrument that really has a 70-year time horizon? Or do we want to match that up? And in portfolio management, we call that duration matching. So we try to match, the liability with the income stream.
Now, we have a Fitzwilliams approach to this as well, too. And to keep it simple, right before I pass it back to Tim, I want to go back to my 45-year-old who isn't going to need retirement income until he's 65 years old. That's 20 years that they have to play out to figure out if these big AI companies are going to ever become profitable, if they're going to reach profitability and be able to turn around and produce the future fruit that everybody's banking on, the 60 years worth of forward earnings. Or are we maybe 75 years old today listening, and we're currently taking required minimum distributions? Most of our investments are our IRAs, and we might not even be healthy to live to age 100 or even age 85 rather. Tim, give us some clues as to kind of the Fitzwilliams approach and how we approach this, and why everybody should even have a process for approaching this in the first place.
Right. Well, let's start with why should you have it, because it's important, right, to understand a plan, to have a written plan, if you will. It's just complex. It's extremely complex, and it can be very intimidating to try to get all your information figured out and where your desires are and what factors equal what. So that's why we developed this system, if you will, this strategy to keep it real simple called Thrill. And so what is that? That's Thrill, where T is for taxes. And what does that mean to you? Are you concerned about income tax? Are you concerned about leaving money to your heirs and it being taxed? Are you concerned about estate tax? What is it that's going to concern you about taxes? You might not be concerned at all. So we're going to rate each one of these as we go with you. And the next letter is H, which is for your health. Health is your greatest wealth. We've always believed that. If you have something going on in your life that's a significant health concern, it can change everything about your financial plan. The next letter is R, which is for risk. And that's easy to say, but hard to truly analyze. That's where we want to understand your risk tolerance. But deeper than a 50-50, 60-40 type blend, we want to understand more things about that. What type of risk tolerance do you think is of value? What do I mean by that? If we have two portfolios, if I have a portfolio that's earning hypothetically 10%, and you have one that's earning 10% as well, but ours took significantly less risk than yours, which one has more value? Well, ours would in that case, right? So can we create value by bringing less risk to the table? Do these things you've heard Ron talk about, in intraday modeling and analyzations and putting shorts on to be able to hedge our gains and to prevent losses while we're driving down the road and the fog comes in, does that active and tactical management bring value to you and making you have a clearer understanding of your risk? We find people can take greater risks sometimes if they understand that. Or maybe you're the opposite side where you want to have more hedge in your life, more safety. So do we want to guarantee that, or do we want to build a portfolio that's designed with bonds? Or do we want to focus maybe more on an insurance model where you have maybe some annuities and some guarantees in there to give you a little bit more comfortable anchor to a side of your portfolio, right? And then we have income, I. Look, everybody loves income. While they're working, it's easy to say, okay, I'm making my money, I've got leftover money per year, but when you retire, that may change. Chances are it probably will change, and it will probably go down. People are like, oh, I'm not worried about it. I had $50,000 left over. I'm only going to have $15,000 left over, but my bills are paid. I'm good. I want to tell you, you're not. After planning hundreds of retirements with people, I can tell you psychologically, you're not. The best idea is to try to replace the income that you're used to making. And then if you don't need it, invest the rest. That's the best solution that we find for our clients, right? They want to have that disposable money. The L becomes long-term care. Do you have a concern for that? If you do, let's not pay monthly. It's hard to get approved. It's hard to do monthly. And it has a lot of constraints to it. Let's figure out a way that we can collateralize and do some unique strategies that are with your cash assets and maybe your bond-like alternatives that you have in your life, right? Let's figure out how we can use those things to collateralize assets to give you that long-term care you want without necessarily coming out of pocket net. And then lastly is legacy. Do you want to leave things to your children and to your heirs? If so, do we want to do it in a tax-advantaged way? Do we want to divide it up in a certain model? Do we need to transfer a business a certain way? How do we want to see legacy? And some people are really concerned about it and some are not. But it's something that we're going to ask you. So you're going to go through and you're going to rank each and every one of these on a level of 1 through 5 of what's important to you. And as we understand that, that helps us understand when we see the real complex stuff like the data and the accounts and the value and the different plans you may already have, we can mesh that together to give you a better position of your total financial plan.
And so that's how we get to know you. But Corinne, how can our listeners and our viewers get to know us?
So besides our podcast and our radio show, a great way to get to know us, and, you know, one of my favorite things to do is spending Tim's money. So one of the things I'd like to do is invite you guys, if you have questions about your retirement, if you haven't been to one of our dinner seminars before, call our office. We do dinner seminars at all of our different locations throughout the year. And, you know, call our office, answer a few questions, and come out and join us for one of our dinner seminars. Our number one goal is to help educate people so you know where you're at and what you have. And if you are interested in coming out to a dinner seminar, give our office a call at 757-961-0700. Again, that number is 757-961-0700.
And before we sign off for today, folks, I just want to let you know that is a completely complimentary offer. You give our office a call. You visit us on the web at www.fitzwilliamsfinancial.com. It's completely complimentary. So what does that mean for you? It means something very, very simple. I'm going to break it down. If there is just a 1% chance, if there is a 1% chance that a conversation with us could improve your current situation, and we're willing to buy you dinner so you can get to know us and have a couple of complimentary meetings so we can get to know you, for that 1% chance, it seems like a no-brainer to us. Would love to hear from you. Give us that call, 757-961-0700, or visit us on the web at fitzwilliamsfinancial.com. Until then, God bless you. Take care of yourself. We look forward to seeing you soon. Take care.